with their domestic equity and bond portfolios because they tend to thrive during periods of economic growth and low inflation. And we don't blame you. It's been a great ride. But it's a big world out there, full of opportunities you may be ignoring. Sadly, we live in a world dominated by a fear of missing out, or FOMO. And in the last 10 years, U.S. equities and bonds have outperformed and generated massive amounts of FOMO. This hasn't always been the case. In the mid-2000s, the best performing markets were international equities, especially emerging markets, gold and commodities. So what happens if growth collapses and inflation becomes the new norm? Or what if the US dollar collapses and US assets are no longer attractive? What will the new FOMO markets be? And will your portfolio keep up or be left behind? Enter Rational Resolve Adaptive Asset Allocation Fund, ticker RDMIX, a strategy that is designed to thrive across different markets and economic regimes. Unlike most traditional strategies that keep allocation static and let volatility happen, adaptive asset allocation applies a proprietary systematic process designed to dynamically transition toward thriving asset classes and eliminate those that are not, all the while aiming for consistent volatility and stable returns. There's almost always a bull market somewhere in the world. Don't let yesterday's FOMO get in the way of tomorrow's opportunities. Instead, let adaptive asset allocation help you fill in your domestic portfolio gaps. To learn more, visit rationalmf.com and check out the Rational Resolve Adaptive Asset Allocation Fund.
Evening.
All
What a
right.
beautiful video. Rational MF, rational motherfracker. What's that stand for?
Yeah, I was just thinking the same thing. It's the first time I put the two and two together. I bet a lot of people are going to be happy that this one is over.
Meb the dude. The dude abides, bro.
I was trying, now that you guys mentioned Lebowski, I was watching some YouTube clips and I was trying to, I'm out of home, out of office. I'm homeless right now. So I don't really have access to my clothes, but I was going to try to find some sort of dude outfit. And this is the closest I could come. I don't have Corey. Corey wears this like on the daily, this sort of like weird sweater robe sort of mismatch.
The sweater,
maybe not in the Caymans, but in LA, spotted in the wild wearing it quite a lot.
Oh, that's too good.
So where are you at? So you're homeless right now, but where are you located?
I'm homeless, so I'm open to some travel destinations in the next few weeks. I tried to time my home renovation for the worst possible time of, say, the last 20 years between supply chain and rising costs and everything else. It was supposed to be done about a month ago, so we're on pace for my expectations. So hopefully soon. I'm still in LA
now. Are you renovating next to Wes in Puerto Rico, or
we're still LA bound,
down by 30%?
We're still LA bound. I love Puerto Rico. I not quite sure we're gonna transplant, but I thought it was gorgeous. We had a great time.
Indeed.
And the best part is I got to muck up the bedroom before Philbrick came to visit a week later. They're like, Philbrick, I'm like, don't even change the sheets. Like that guy, like just
I insisted
we slept on top of the
sheets.
sheets. We're all good.
Yeah. No, I insisted. I actually had them pull the sheets and then put them back on.
But we were there, and Wes is like the day we showed up, there was like a big BBC article that like it was like or Time Out, I can't remember, but it said is the best restaurant in America in Puerto Rico. There's like a little farmhouse outside of Palmas del Mar, and we went and had actually a pretty awesome meal. But I had a blast. If I was childless, probably I'd definitely consider it. On the West Coast, like Rincon, near some of the surf breaks, but definitely love to visit.
Well, you have to get your tickets ramped up for your visit to Cayman, bro.
Yeah, man.
Well, you guys come up with an event. When's the next event?
West Coast?
Definitely have to schedule an event. Rod's on that like a fat kid on a Smartie.
I mean, it doesn't have to be like a fancy
you gotta
event.
come to the real
You
vision.
can just
There's
call
gonna
it
be
like a happy hour, and I'll come down. So
we gotta, there's a big Real Vision
Done
meetup in November of this year that I'm sure we can get you an invite too. Do a little
Last time I
speaking
was
engagement.
Last time I was there was during the Zika tour. That was at like peak Zika.
That's right.
Yeah.
I remember that. Wasn't your son just about to be born? Like,
yeah.
Didn't you come with a pregnant wife?
Well, no, she wouldn't go. And I went to I was in Mexico City. I was in 4 places on my Zika tour. And she's like, you come back, you're sleeping in the other room for about 2 months. So
you were you did an OG quarantine. That was way before quarantine was cool.
You know, ahead of my time.
Yeah. Well, before we start jumping into the investment stuff, just to make sure everybody knows that you shouldn't take investment advice from a YouTube show at 4:00 in the afternoon on Friday, because we don't know anything about you, and anything we talk about, all performance is not guaranteed of anything. So there you go. Now we can have a chat. Just wanted to get that on the record.
Speak for yourself. You can take advice from me, listeners.
That's so true. It's so unfair. They can.
So you had a big announcement today. What
oh my God.
You're giving something pretty important away.
Give us the airdrop. What's the coin we're getting? Meb coin? It's got to be
big announcement for me. Maybe not as big announcement for anybody else. You know, we struggle with a lot of things in our investing world. One of which is historically been just information, right? And dealing with this just deluge of content all the time and separating what's good from what's bad, noise from signal. And so part of the problem I said is I want someone to curate this. And the problem with that was that no one was doing it. So we said, hey, maybe we'll start doing it. And there's a giant leaf blower outside. So you guys tell me if you pick that up. It's too loud. What's that?
I fucking hate those things. I swear to God, they're no more effective than any other, than some sort of.
Seems like a big opportunity for electric-based leaf blowers. I don't know. Tesla, get on it.
Yeah.
Anyway, so you guys just wave at me and tell me if it gets obnoxious. I'll move rooms to the bathroom.
Honestly,
we can't hear a thing.
I've always wanted to do a live stream from the toilet. So from the loo, you guys give me that excuse. Anyway,
give me the excuse.
So we did this 10 years ago where we started this service. I said, look, I'm going to curate what comes across my desk. So the best available public research, but also the best available private research. So if I reach out to my friends that run newsletters or boutiques and say, hey, or investment banks, all these various avenues for research, and say, we'll share the 2 or 3 best each week. It's called the Idea Farm. You can go to theideafarm.com. We charge $500 a year for it. And we did some other bells and whistles. We had some Excel-based models. We do quarterly valuation updates, on and on. And been doing that for almost a decade. This summer would have been 10 years. And it's been awesome. But, as our business grows on my day job, like you guys managing money, the underpinnings, which has always been very mission driven and sort of a hill I'll die on about investing access and research. Granted, this is more pro focused, but I said, you know what? We want to try to make this free. So we're opening it up starting this Sunday. So it's now universally free to anyone. You can sign up, pass it along. The way we're doing it now is every Sunday you'll get one email. So you can read it with your barons, having coffee, watching football or sports or whatever it may be. It's going to have the top couple research pieces, the top couple, podcasts. We'll do private. We always ask permission. So if it's Goldman or some private newsletter, we say, hey, can we share this? Usually they say, sure, because it's going to a very, curated list. And the best part in my mind is that all the archives are now free. So you have 10 years of, I got to count it, but it's somewhere between 500 and 1,000 research pieces. Wow. And you guys have been in there. You guys have been featured. So we'll go Google. We'll search the website, see how many pieces y'all have in there.
There's a lot of data too. You share a lot of databases, Excel sheets and stuff that have been really useful for,
So we've hired full-time people now to run this kind of show and improve it. So listeners, if you've been subscribers, let us know what you're interested in. We have some ideas for it, but we're just excited to get it out there. The personal emotional feeling of it being kind of gated or quarantined is always, it's been tough for me, but hey, it's helped us survive and build our business. So thanks to all the people that, were subscribers for the last decade. But we're pretty stoked on it.
Yeah, that's very exciting.
Gift.
It's a little pain. I say a little painful for me personally, because I'm just like anytime you're like shutting down a business that's actually like successful and running, it's a weird feeling, having like y'all, starting things from scratch and bootstrapping, and then moving to a period where it's just not a focus. It's painful for me, but it's Friday. We're doing Resolve Happy Hour, so I'm cool with it.
Well, cheers, man. That's
yeah. Congratulations.
Generous. Yeah, and it's nice to have some ballast to the wealth management business or the asset management business, right? That can be volatile. And I mean, once you get above a certain threshold, then your belly's not dragging on the runway every couple of years when strategies are out of favor. Then you've got some more latitude. But it's nice to have that ballast to keep the business running when.
Yeah, I mean, I think the curation trend, there's still a lot that could be developed there, not just in our world, but in any demographics. There's a few businesses that have been trying to do it, but I think it has long legs. I think a lot of people would characterize it now as like, hey, I'm going to do an AI focused, filter to this, but I think that's a huge business opportunity of actually teasing out like the good content from just the noise.
Are you still doing the podcast sort of oversight stuff as part of your communication of good content, curation?
Yeah.
Of good content?
So it'll send out the top 2 or 3 podcasts each week, investment related, and sometimes we'll throw in a wild card that might be something else. The cool part about this is it also has free Spotify playlist that goes back like 4 years now. So if you look up Idea Farm Spotify, it's got the top 2 or 3 podcasts each week for the past 4 years. And you combine these two, and I this is self-serving, but 99.9% of it is not my content, it's someone else's. I think if you were a student, a young person, even a pro, and you go listen to these podcasts, you go read these pieces from the top institutions all over the world, managing trillions of dollars, like to me, that's way better than a grad MBA or PhD degree.
100%.
I mean, it's incredible. And so anyway, I don't know anyone that's plowed through them all, but if you have, awesome. But if you search on Spotify, and we need to add that link to the site, but there's 3 or 4 years on there, and y'all got some too. So we'll have to see which ones they are.
It's always interesting when somebody comes up to me and says, listen, I really want to learn about the market. I want to get that education. Where'd you go to school? What do you think my career path should be? And when I ask them specifically, is it that you want to manage money? Then honestly, an undergrad in commerce, an MBA, a CFA is not going to get you anywhere close to the content that we've kind of all created in this little bubble, right? There's a lot more value in the things that you put together, that Wes put together, Corey, Resolve, that kind of FinTwit crew, that I never send them anywhere else. You know what I mean? It's so much value didn't exist.
Kind of closing the loop on that. I think there's opportunity for some business models. I mean, you have Masterclass that does it. And I was joking a while back on Twitter. I'm like, you have Masterclass for wine, barbecue. The Franklin one is awesome, by the way, on and on. I was like, how do you not have any about investing or any like day-to-day life skills? I said, it's an opportunity, and you're starting to see some of these business models pop up. I saw one the other day. For a startup that's doing kind of this life school, all these things you weren't taught in high school, but you need to be an adult, right? Like some of these just basic stuff, but one for kind of 101 level investing, but then also 201, 301 levels. And, having someone, I don't want to do it. It's way too much work. Having someone curate that sort of curriculum, to me, that's a 8-figure idea, maybe 9-figure idea, but well,
I saw a couple of master classes on TikTok on options trading, really small cap stocks. So I'll send it your way, Meb. Maybe you could put it in the idea farm.
Yeah, I love it.
Okay, so that's a very exciting announcement. In the main business, what are you excited about today? What have you been seeing?
excited about today specifically. You guys timed this interestingly. What the market do today? Down 3-ish.
-4 for the NASDAQ, -3 for the other stuff. I mean, whatever.
I was selling May and go away, man. I was joking on Twitter. I said, I'll see y'all in the fall. I'm part Southern, so I can bring out my Southern roots. I said, I'd love to go on a 4-month sabbatical. Although after the last couple of years, man, I was like, can we just have like a quiet quarter where just like nothing is going on in the world? We have crazy inflation, wars in Europe, pandemic is seemingly kind of just sticking with us. So what am I excited about? That's a good question.
Well, as you're pondering that, do you think this action today is a bunch of preemptive sell in May stuff? Is it just the simple folks just saying whatever, I'm out? Those models?
I was talking to a buddy last night. We were golfing, which listeners probably laugh. I'm not really a golfer, but when everything closed down, when everything closed down in LA, it's like the only thing, the like golf lobby had to be, the politicians or something. They kept the golf courses open. They even shut the beaches for a while, which is obviously insane. So you couldn't surf, couldn't do anything. So I started playing golf, mainly for this great happy hour spot. So listeners, if you're in LA and you want to meet me at Pinmar, let me know. I'll take you out. It's a $15 muni. But was playing with a friend yesterday, and he's like, Meb, this market, I know your shtick. All the indicators in my mind, speaking to large cap US stocks, are looking pretty gnarly. And we've been kind of doing this message for a long time where we talk about the market in terms of yellow light and red light. And yellow light for me is like all these signals, valuation, all the crazy stuff we saw last year. We have a tweet thread that we were doing for a while called What in Tarnation, where we talked about just kept adding chart after chart. It was in February 2021 of just the craziness, right? It's so similar to 2099. And so you go read that and it's just like, God, what were people thinking back, a little over a year ago? Anyway, all these yellow light things. And then, but we've always said, like, the final boss, and even historically speaking too, this is the worst setup, is when you have an expensive market, but then when it enters a downtrend, so once it actually rolls over. And so you kept having for the past couple of years, all these yellow lights, but the trend may roll over briefly, but go right back up by the dip, right? And so now it's rolled over. And what we know from history is you kind of do that quadrant of cheap uptrend. S&P historically has done like 17% a year. But expensive uptrend was number 2, and that's usually okay. You get reasonable returns. But expensive downtrend is where things get, gnarly, and usually historically the returns are 0. And so you couple this with all the stuff going on. I mean, let's not even get to inflation. Like you want to see a just vitriolic, angry response on Twitter. Look at some of the tweets where I talk about inflation and stock multiples. Historically, stocks hate high inflation. And so you have average multiples, then you have high inflation multiples, and those are like 10, So long-winded, typical Meb answer. You guys don't get 1 minute answers with me. Talking to my friend playing golf, and he said, what do you think this can do? I said, look, maybe we rip right back up. Maybe we go down a little bit. I think the most likely scenario from peak to trough is like a 08, 2000, down 50. And he's like, oh my God, that's crazy. I'm like, what do you mean it's crazy? Like, that's markets go down 50% all the time. Like, look at half the foreign markets over the past decade. You live in any number of these countries, they go down 50%. They call that a Tuesday, So, I mean, Rod from Latin America, I mean, half those countries, like that happens, once a year, I feel like. So not a big deal, but like to me, super. And the weird part, and people love to dunk on me for this, I say, look, my largest fund is a long only stock fund. So it's not like I'm just specifically talking my book here. This is kind of what I see from the research. And you guys just did this amazing podcast, and we got to talk to him recently too, Antti Ilmanen. And he's put out a great book, which I would show on the show. I would hold it up, but it's actually my laptop stand. expected returns. What is it? Low investing
in mid,
investing
low
in low
expected
return.
returns.
Okay, sorry. I was enjoying the book so much the other day at a lunch place at a restaurant. I left it there and had to go back and get it about an hour later. Anyway, so I think today is normal. As we know, in downtrends, volatility is much higher, both up and down. So you get two-thirds or 70% of the worst days happen in downtrends, but the best days too. So you see that volatility expand, and this feels like that. In the market, the U.S. large cap weighted is kind of the last shoe, and it's down only like 12% or something. It's nothing yet.
And
Now,
I guess we're getting
a lot of
that
carnage
official,
under the water, but yeah.
Yeah, I guess we're getting that official close below the 10-month moving average too, as of now for the S&P as an example. And so you've got your initial work back. What was that? The Ivy portfolio back in the day?
Yeah, man.
10-month moving average. So, things behave differently below the 10-month.
I kind of like it when the market closes on the final day of the month to in this way that gives all the monthly moving average products a hard decision to make.
Yeah. Well, but that's the thing is
last month was hard because it was close. This month is not hard. It's like you are now 5%
solidly below.
We've talked about this probably on prior ones, but look, a lot of the research that we put out as well as others is meant to be kind of instructive and basic and simple. And I think the challenge, particularly with the time series ideas, but it really applies to any investing methodology. People love to get set on one asset or one concept. I'm a gold bug. Guys are Canadian. You can resonate. I'm a dividend guy. I'm bearish. I'm a whatever. And the challenge.
Those are all Canadian sentiments.
I think those are all Adam sentiments.
I'm trying to speak to my audience, guys. Give me a break. I'm reading the room. But if you look at it and think about it, that's probably like the worst way to be an investor is to be inflexible and be adhered to one
dogmatic
outcome, right? And so there's a quote that I just can't get out of my head by Adam Grant, and he talks about I don't want, and I get it backwards now because I play it both ways, but he's like, I don't want my ideas to become my identity. So in my head, if I'm like, all right, I'm a gold bug, all day, all I'm doing is looking for confirming gold going up evidence, when in reality you should be doing the opposite. Like a good portfolio manager analyst is constantly like trying to tear down their ideas. And so but the opposite is true. I don't want my identity to become my ideas. And so applied to something like some of these systems that have a very specific trigger, to me is crazy. Like y'all talk about ensembles, Corey, and all these others, and to me that's the most thoughtful way to do it. Now, why don't people do that? It's because people secretly like to gamble, right? So how many times you guys had a conversation with someone and said, hey, what do you guys think about US stocks? What do you guys think about Twitter? What do you guys think about Bitcoin? Should I own it? Should I sell it? It's never like, should I sell a quarter of it? Maybe should I dollar cost average into this? Maybe I should, because they want to gamble or they want to be totally in or totally out, which is crazy. And so a lot of the ensemble ideas, to me, it's a much more thoughtful approach, but it's particularly fun watching some of the washing around in whether it's the momentum funds or names, where you can see that window just so the perfect example all time on this is a long-term moving average system applied to 1987. And if you had something like a 200-day or quicker, shorter, you would have been out during the crash. I mean, people freaking out about a 3% down day. That was 20. And then 200-day or longer, and you were invested long during the crash. So career-defining outcome. Mm-hmm. But the reality is, if you had an ensemble, it would have been, mixed.
Half in, half out. Yeah, exactly.
Right.
And that's a win.
Nobody wants that. Nobody wants to cheer for that.
No, but this is it, right?
They
like this is who gets the big check.
Yeah. Go ahead.
Who gets the blue check mark on Twitter, right? I mean, Meb, I know you got a blue check mark. I get it. But you're the exception.
It's more
right?
turquoise. It's actually just like a emoticon that's turquoise.
I kind of feel like Elon's going to cancel you soon, but there's too much free speech coming out of you. The vast majority of guys that get this type of following make absolute statements. This is something like in human nature that people love. They want to know for like who's the most certain and the most adamant that something's going to happen. And what ends up happening is the person that got it right by flipping heads 10 times will bubble up to the top.
No, so then who got it right now, ex ante? Like who got it the most right now?
Remember Dr. Doom? All those guys in 2008 that got it right, like Peter Schiff, who's a Dr. Doom?
Perfect case study.
Prechter,
Rubini. But
Rubini. What was the woman from?
Well, because there's another Doom, which is Faber, but he's actually pronounces it Faber. So there's a couple Doomers.
Marc Faber. Yeah.
Somebody's emailed me the other day, and they're like, I've been following your dad. I'm like, who do you think my dad is? Because I don't think it is who you think it is.
Oh, dude, that is perfect.
Do you think it's David Faber? Or do you think it's Marc Faber? Do you think it's
over time you're starting to slowly look like
him?
Could be my dad. That's where you end up.
I've heard about that, Faber. He could be my dad. I'll go hang out with Dad.
But so one comment is like, if you look at some of these star portfolio managers over time that people flock to, and let's be clear, this is not just a retail phenomenon. Like advisors and institutions consistently get drawn just like, flies to what, because it's not just an individual, it's a human condition. They're universally smart, they're charismatic, they're very opinionated, but they're often too contrarian. So they tell you things you may not have heard before. And we could name probably a dozen of those right now. And that's a great way to play that game if you want to raise money. Now, the problem then is you're building this cult of personality about, chasing hot managers. And as we've seen, Bogle's been talking about this for decades. That's a really, really bad idea to chase the hot hand, particularly discretionary.
Yeah, well, Meredith Whitney was the other one, right?
Well, yes,
there's thousands.
Yeah, she got hot for.
And today, isn't it ARC? Isn't that the same thing? A woman that
gets was
on
ARC.
TV
well, yeah, maybe a year ago.
Says that she expects a 40% rate of return in the next 12 months. I mean,
Rod, you were ARC. Like
Rod, you're out of date. First of all, that was. If you were in Miami, that was up to 50% from 40. And that's from share prices of a few weeks ago. So it's up to the math should be up to 55% today, and pretty soon up to 60%. But we ran a study on industries over the past 100 years in French Fama and looked at how many rolling periods, even these tiny industries like coal stocks, right, had 50% returns for 5 years. And it was like this is 40%. It was like it was a rounding error of 0.01%. Basically, it's happened like 2 times. It was like coal stocks and like something else. And the heart, like it's we could go down an entire rabbit hole there, but that
we're down the hole, man. Give it to us.
Yeah,
let's go.
Sorry.
Let's do it.
Here's
do it. But so you went down the rabbit hole. And you say, how often does this happen?
The realm of what is possible and what is probable, and the conviction to say that, it's to me, really hurts credibility, right? Like it's just
almost irresponsible,
right? I think it's really irresponsible. But as Dumb and Dumber said, there's a chance. So
so you mean there's a chance?
So let me ask you a question, because this is something that is really tough for me to reconcile, right? So we talk about these people that talk their books and they're overly confident, they are narrowly focused, and it's their value systems fully attached to that. That leads to irresponsible outcomes. I found myself today in an interview that Mike and I did about one of our ETF in Canada. I found myself being very proud, very dogmatic, very over the top about how much I believe people should invest in this broadly diversified way with risk parity and long short trend and multi-strategy futures and tail protection as a whole solution for, and I stopped myself for a moment and thought, man, people must think I'm a zealot, a lunatic for being so aggressively married to this concept. So I'm trying to find a way to articulate the difference between believing in a framework of diversity and diversification and believing in the framework of Bitcoin Moon. And because people will see it as the same thing.
Why did you just extrapolate from zealot immediately to Bitcoin? Like, no, you didn't have to cross that bridge. We just lost half our live streamers.
There's no zealots in Bitcoin, dude. It's just called Bitcoin.
And you missed that was the conference right before we were there. It's 10 times as many people. Right? So what do we know?
Exactly.
You know, I mean, look, it goes back to, you know, I think one, an appreciation and an understanding of history, two, of just being thoughtful of, like, it's like talking to experienced professional gamblers and speculators, but like, say, in Vegas. And so you have the Bill Gross, the Ed Thorpe, you know, the card counters who understand how the game is played. And then you have the people, and you go sit down at a casino, who sit there and they play totally by feel. Now, those people may win, right? And they believe it, you know, and not only that, they often will, like, yell at the card counters for playing irrationally or doing something that, oh, you hit that, you see, because you hit that, I got a 7 and now I busted, like, I blame you, right? They believe that. And now you would say that that's not a thoughtful understanding of how the game works. It's not like, and you go to a poker table, like those, and it's actually really depressing to sit there long enough because those people all get washed out. It's like a old, was it Rounders, where there's like a time series of, like, the pros sitting there and they just keep churning the empty seat, right? Like, it's just eventual, like, it's an inevitable outcome. And so just by the law of large numbers and power outcomes in our investing world, I mean, we could say this with so many examples. I mean, this is why people are consistently attracted to expensive lottery ticket stocks, right? Because one out of how many ever becomes an Amazon, and people forget the other 100 that are zeros, right? But so they're consistently attracted to them. But the good news is, and this is like one of my favorite quotes we consistently say, is like, the biggest compliment you give someone in our world is surviving. And you make that list of the hot manager, the zealots for the past 50 years. That list is like a mile long, right? Like, everyone's forgotten them at this point. They're gone. And you talk about the late 90s and Janus and all the other names and crazy things, but it's not just in, you know, bubbles, but other countries. I just started watching a great documentary, not documentary, but show on HBO, Tokyo Vice, but it reminds me of the 80s boom in Japan. Right. Mm. So, you know, I think it's you have the professionals that understand the game and the history, and you'll always have the people that honestly believe what they're selling. And then you have the people that don't believe what they're selling. And, you know, that's an entire another category. But I think it's great to believe in what you're, you know, what you're pushing is the wrong word, what you believe in. And then we get into the other whole concept of skin in the game, you know, investing right alongside your ideas. So, but it's a story as old as time, you know.
Speaking of believing in what you're selling, like, is anyone surprised that, despite the fact that ARK has had this just incredible round trip, that investors have been buying continuously all the way down? I mean, I don't know that we've seen quite a phenomenon quite like this in the past, other than
maybe elaborate, Adam, because I didn't know what I understand is ARK's money weighted returns. So there is positive cash flow.
There's net inflows.
Yeah. And
tell everybody, because I didn't know, so I'm assuming everyone else doesn't know either.
Yeah, Eric Belchunas just highlighted that over the last couple of days. Just the fact that ARK has been accumulating, you know, new creates. Like, there are people continuing to pile.
So money's pouring
ARK.
in still.
Yeah, even while it is enduring this incredible drawdown, right? Are there other examples of this, of managers who've had such a swoon and yet where the followers have been just had such conviction that they've continued to pile in so aggressively. I mean, this to me is remarkable.
Well, there's I think there's a couple elements at play. And Jeffrey Patak from Morningstar has been great because he looks at a lot of the times in history. He's speaking specifically to the 40 to 50% projections. And he says, look, here's the times in history funds have actually done this and their future returns. And it's like doesn't bode well. But my perspective on this is, and Eric has a great tweet where he talks about the 3 or 4 reasons why he thinks it has been enduring. But I think it's eventual. Like I think it's preordained what's going to happen. And to me, I think there's a point, and I think we're there now, where you start to see the redemptions. And part of it, you look at like the various stages of grief and like how, like, if you look at 2003, that lasted 3 years, right?
Yeah,
you had
still in denial.
The people, right? They're hoping
yeah.
it's coming back. Then they're wanting, and like that feeling of going like buy the dip, and then it's like the hope, and then it's the despair, and then it's I don't care, right? And look, that was me. The late 90s, coming out of university. I have PTSD from a lot of these companies, CMGI, Lucent Technologies, a lot of these. Like I probably had carry forward losses for like a decade for some of these stocks, and so, but and we've kind of tweeted about this before. I think 20% down, you hit a certain level of buy the dip. 40, and then it kinks every, I think, 10% after that. I think we're to the point where it's like the eventual like despair part of this, and I think
there is a point where investors just stop looking at statements, and there's an ostriching kind of head in the sand type of phenomenon.
If I go back to living my days, go ahead, Rod.
So I was just gonna say, I tweeted about this with Shopify because I had memories of Nortel, right, in Canada, that represented the vast majority of the S&P TSX 60. Was the darling of Canada. Every investor had that as a line item in their portfolios, and they did the same type of thing. They bought on the way down, and then they just gave up. 10 years later, I get into like the business and start looking at people's portfolios, and they have this Nortel. Every single person had that equity line that they never sold, right? And just gave up on, and it's almost like a token of a reminder of stupidity that they had. And I was looking at Shopify, and I was thinking, this is probably the next Nortel for every Canadian statement 10 years from now that is going to be right next to Nortel, right? Maybe not. I mean, Nortel was a bit of a fraud. Shopify is actually a business model, but was it not a fraud that was in there?
No, that's Briex maybe, but Nortel.
There was some stuff with the.
There was some pension issues and stuff. There was some drama for sure. But
there was some fraud.
I'm not saying Shopify's it, but it's certainly the valuations they got were outrageous, right? Much like
I'm glad you guys Canadians remember Briex, because I was joking when Brex came out, the credit card company, and I was like, you guys just like clearly are young and don't have any experience, because naming this company the exact name of one of the frauds, they'd be like, hey, I'm going to do a startup today called INRON, like Einron. And, it'd be like, what? No, that's a terrible name. Why would you ever do that? And so meanwhile, Brex is worth, I don't know, 10, $20 billion. So good for them. But
I love it.
But funny.
But I listen, I remember 2000 very vividly. I was managing people's money at that time. I remember getting the spin out from Nortel. I remember selling it at 80 for everybody, because those who owned BCE did not need to own Nortel. And I remember getting in shit with those clients, watching it go to 120. And then I remember getting a pat on the back when those clients, when it passed through 60. And, it's a thankless job. You're just wrong at some point. And the, NASDAQ 5,000 pulling back to 4,000 was the buying opportunity of a lifetime. And, gosh, you got it at 3,700. Oh my God, it's so good. And I remember one of the old brokers saying, yeah, that thing hits 2,000 before it hits 5,000 again. And I'm like one of the old saws, just like, as a matter of fact, me as a young kid going, oh, this is the best. come on, technology's going to change everything, dude. It's going to be the best. We're going to be at 5,000 in no time. And a freaking curmudgeonly old guy with a cigarette looks up and says it's 2,000 before it's 5,000, buddy.
Yeah, I'm buying Philip
Well,
Morris, man. What do you
You
buy?
guys remember the infamous video from Kramer on Bear Stearns? The buy. If it was a deal at 40, it's a deal at 10.
Yeah.
Like a day before it went to 2. It's
If we're gonna get on that theme of Kramer's calls, then this is gonna go.
There's always, like there's always like crazy, like we all know that humility is like the number one trait you need to be an investor. You almost have to be a historian, a comedian, but have humility, because we all have the scars, and that's the best thing that can happen to you. But the amazing lack of humility you see in a lot of investors when they're doing really, really, really well, particularly like in the ARC example, they put out that video. I don't know if you guys remember, that was like at the peak of their performance, that was just dunking on value investors, and like the way it was so cringe, and you can find it on YouTube. But you see that behavior all the time where it's at peaks and you're like, oh my God, you didn't really just do that. I can't believe it. Like that's why would you tempt the gods, the investment gods, that way? Because you're just going to take into the woodshed. Like, it's just karma. I'm sorry at this point. Like, it was like when Chamath was comparing his funds to Berkshire.
Yeah.
Performance. Not only that, got all the performance numbers wrong, but still compared them to Berkshire. Then it has a bad year. Berkshire's doing amazing this year. It's Berkshire weekend, by the way.
Yeah.
And then doesn't mention it the next year.
No.
Zero mentions of SPACs this year. And I'm like, come on, man. If you're gonna take the W's, you got to take the L's.
No, but
and
he explicitly wrote that he is no longer going to track himself to Berkshire Hathaway because they have taken a different route that no longer correlates to the same type of mentality or philosophy as Berkshire does, and it no longer makes any sense. So you can put up numbers against Berkshire one year and then just say you're not going to do it anymore without showing the numbers as to why. It was an outrageous letter. I could not believe it.
You have to be a good loser to exist in our world. You have to talk, like in my mind, you have to not only embrace the losers and learn from them. One of my favorite quotes, and I attribute this to Marc Yusko. I don't know who actually said it, but he says, every investment makes you richer or wiser, but never both. And I love that investment, right? Like, what do you learn from your winners? Jack shit. Like, what do you learn from getting taken to the woodshed on some idiotic stock or cryptocurrency? Well, you could choose to learn something. Many don't. They blame whatever. But you want to hear a great Berkshire stat just while we're here? I saw this on Twitter and I said, this is the most amazing false sounding stat that's actually real that I've ever heard, probably certainly this year, but maybe for many years. And Chris Bloomstrand was talking about this, and he said, going back to the 1960s, the Berkshire Partnership, Buffett could lose 99% drawdown from today and still be outperforming the S&P. And that is the most amazing statistic I've ever heard. Like, you're like, there's no way that's
mind-blowing.
Factually correct. And then you go do the math for whatever that is, 60 years compounding at 20% versus 10, lop off 99%, and you're still beating the S&P. And there's some lessons in there, obviously. Like, it's amazing. You compound at 20%, which is always funny when we're going back earlier to talk about compounding at 50%. Wes, our buddy Wes, has a great article about like even God would get fired as an active manager. Mm-hmm. But it's like, if you compound at 20%, you eventually become one of the richest people in the world long enough, period. And it's always funny to look at people, whether it's expectations, which was 17% for US stocks, by the way, a year ago, whether it's like these hucksters that are talking about, 300% gains and like all the advertising. You're like, yo, you don't need way too high. Like, you can just project like slightly above average gains and you'll become incredibly rich. But wow, what a stat.
Yeah, Adam, funny story about that article. When Wes published that article, that day you published an article about having an ominous investor that knew exactly which asset was going to win in X amount of years, and a diversified, risk managed portfolio at the same level would have outperformed still, even that single asset class or something like that. Sure. It was interesting that you guys came up with.
It was a time in markets where that I guess prompted that kind of thinking and warranted that type of sharing. But Yeah. It is. This is a very, very difficult business because when you're doing well, like Mike always tells a story of because we manage a wealth practice in Canada as well, and so we have these annual reviews. And I remember back in I'm going to get the years wrong, but 2011, we did 8%, and the market did whatever 20% or something, and clients were giving us grief for why did you do so poorly, or why are we lagging? And then 2013 we did 8%, the market did minus 10 or 12% or something, and clients were very happy. And we're like, we said we just kind of want to do 8% a year, and we don't want to be tied to the market, but it's just so hard, even when clients say that they want sort of steady returns of 6 to 8%, which would be remarkably strong performance at a reasonable level of all. That's not really what they want.
You hit on a couple great things. One is, I was joking with someone the other day. I said, every investor professional, by the way, and they're guilty of this almost universally. They say, I'm a process-driven investor. We have a committee, rigorous process. We invest based on process, not performance. And I say, really? Interesting. Because 99% of the professional investors I talk to, yes, they have a process on what they buy, and then they have zero process on what they sell. And let me give you an example. In all the years you've been investing, all the years I've been investing, I've had plenty of people that will say, Meb, your fund, we got 12. So there's always one that's garbage performance over any time frame. So Meb, your fund's garbage. It's underperforming. We're selling it. You know what I've never had, and we've had plenty of these too. Meb, your fund is doing amazing. It's doing better than we expect, so we're going to sell it.
Right.
Never heard that once in my life, right?
Mm-hmm.
What they say is, Meb, you're brilliant, you're handsome. I can't believe how good this fund is. We're investing more. Okay.
It's making me cringe right now.
But going back to your earlier part of the discussion,
so true.
I love to say this for people. And look, we've been through rough times in plenty of our strategies. I mean, look, we're a value trend shop at heart for the better part of our existence. Those two ideas were out of favor. The last 2 years, hey, it's been very uncomfortable because so many things have been working as opposed to the prior 7 years of you don't
know what to do with yourself.
Oh, preach.
Right. But it's funny because people come up to me and they'd say, Meb, this fund's garbage, the strategy, like it's down. I bought it 2 months ago and it's already down 15%. I'll say, oh, it can get way worse than that. And they get taken aback. They're like, what? I'm like, that's nothing. Like this fund could outperform for like 5 years in a row, underperform by 5 years in a row. This fund could probably go down 50% and be within the realm of like our expectation. And they'd be like so surprised. And like, no one's ever going to tell them that, but that's the reality. And then you guys have heard me say this a lot, so it's old hat, but maybe the listeners haven't. And I've changed my mind on this, but if somebody asks me how long they need to give for one of our funds and allocations, I used to say 10 years, in which no one will do, but like that's the correct statistical answer. I think it's actually closer to 20, which no one's going to do also. Yeah. But statistically speaking, that's probably the right time horizon you need to determine if this strategy is actually, Meb data mined or actually thoughtful construction. So nobody wants to hear that. They want to hear what
even then, we've done some work like a few teams have these long data sets, Goyle and Fama and et cetera, right? And some of them have these large factor data sets. And Wes's team publishes back to 1990, but the Q factor guys published back to 1962 or something, like 120 different factor portfolio strategies. And so, it's remarkable to go back and have a look and try to see if you can identify the strategies that are legitimate or that are likely to outperform in the future by examining their performance in the past using a wide variety of different ways of doing that. And I have yet to identify a method where you can say, enterprise value to EBITDA or asset growth or, one of 160 different factors. Like, can you take the top half based on 40 years of performance and then continue to do that on a rolling basis? And what works? own them all in equal weight.
Was
Because
it
there is
Corey?
actually no way to identify, even over 30, 40, 50-year horizons, which ones are actually going to go on and outperform.
Well,
Didn't
we
Corey
talked
do
about
one as
like
to how
oh, sorry.
long it would take to disprove that value was dead?
Yeah,
And it was
and
like
he used
67 years.
he used a really thoughtful method. Yeah, his factor Fimbulwinter, I think, and he used a Bayesian approach. And yeah, it was depending on the volatility of the strategy. It was like, I think low vol or bidding against beta required like 40 or 50 years, and momentum required like 300 years or something. It was, I mean, the reality is you either believe that this thing works for, and you know, and we can probably get into some other more technical ways that you might gain more confidence, but just having the performance numbers, there isn't enough time for you to determine that something is a real thing during your lifetime. You either believe it is because it makes sense to you, or you don't. And you know, that's
underlying economic reasoning as to why, and then you just
the time horizon
diversified with.
The time horizon mismatch is like one of the biggest problems, where you ask people, you say, okay, the number one most universally held belief, and I don't know really anyone that doesn't hold this, is that stocks outperform bonds over time, right? Like everyone, ironclad universally held belief. But then you ask people, like, how long would you give stocks underperforming bonds before you would sell that allocation? How long would you tolerate that? And you can mask it, actually say not stocks and bonds, but just say this asset or this strategy. And usually it's like 3 years. People are crazy. They may say 5. But we all know stocks plenty of times have gone decades. In the US, even if you go back to the 1800s, it's like 60 years of similar performance as bonds. 2020, stocks have gone 40 years in the US with same performance as the long bond. And, you know, that is a long time for something that is universally held belief that they outperform over time. But over time is the key part of that, you know, statement. Like, what do people really think over time means to what do people behave on what over time means? And, you know, that creates all the problems that we all know.
Well, when you think about that, and if people did think about these things over 20 to 60 year timeframes, the call you would get is, Meb, just checking, making sure the process is the same, or process is the same for your particular strategy, because it's performed so shitty. We wanted to make sure we added some capital because we know over time the actual forward-looking returns are better than they were when we first made the investment. And so we're over the moon at this opportunity to get more money in at better prices.
I'm going to tell you guys.
I've never got that call ever.
I'm going to tell you guys I'm going to tell you a funny story. Is that, you know, we see on Twitter and elsewhere and everywhere, and it's a seductive thing to do, and I get it. It's like you want to cheer when you're doing well, but you know, I said, you know what, I want to write about one of our really terribly performing strategies and share it just to like demonstrate, like, A, we still believe in it. It's been a bad environment. Try to demonstrate some of this, you know, humility. And so we wrote an article a year ago, like January. It's called Totally Not Crushing It. Totally Crushing It, but the not was in parentheses. And it was about a simple strategy of buying value and momentum stocks, but then hedging that in the US top down with S&P futures based on top down US stock market valuation and trend. So you have like 5 different terrible decisions over the past 5 years. This looks, by the way, and when I feel too depressed about it, I go and compare it to, there's funds by AQR, Gotham, Vanguard, by the way. Vanguard has a market neutral mutual fund, which would surprise a lot of people. They all are as atrocious as ours, so I take solace in that. But we wrote this article, and no one's interested in this fund, by the way. It's just me. And then sure enough, over the last 2 years, it's been fantastic. So like, I'm like talking to the investment gods. I'm like, all right, you show humility, talk about your losers and what does poorly. they will bless you with some
sacrifice to the gods,
magic sprinkled dust of not taking a victory lap. But I got a lot of good responses from it, because people, all they hear all day is, we're crushing it, here's why you buy our strategy. And I was like, look, here's a strategy that has sucked, no question about that, but we believe in, and here's the reasons we believe in it, and we think we'll do well. Now, no one allocated to it, let's be clear, because it looked awful, trailing equity curve. And it's been amazeballs the past 2 years and this year as well. And so this urge of like, and some of the old CTA writers used to write about this, Tom Basso and others, about allocating during drawdowns to strategies and managers. Because if you believe in a manager and the process you think is this, and by the way, for me, this applies to like assets and sort of strategies, quant strategies. Discretionary to me is like a total nightmare. Like trying to decide if, Kathy or David Einhorn or some, discretionary manager is good, or they've lost it, or they just want to hang out in the Caribbean, or they got divorced, or their kids are mad, like the 1,000 things that affects discretionary, like total nightmares. I don't really apply to that. But, and the other thing is, like, all the evidence shows, like, you want to be investing in things that have been destroyed. I mean, look at energy 2 years ago. It was down 80%, 68%. So
tobacco in 99.
I don't think we want to.
Yeah,
I don't think we want to necessarily suggest that for every strategy that if you're in a drawdown, it's a more attractive time to buy. There are definitely some strategies where when something's in a drawdown,
give me a strategy that wouldn't be good in a drawdown. That you would, strategies that you believe in and you want to allocate to.
Yeah.
So all I'm saying is you don't want to buy them at when they're performing well, but I don't think they're any more generally attractive when they're performing.
The consistent concept is to rebalance, right? So you're consistently coming back to target. And I think there is a parameter which you could argue you could, quote, over rebalance too. So if you're doing a basic risk party allocation and you get to something like US stocks are down 80, well, maybe you would rebalance more than to target. I don't know. It's an idea that I think is probably incrementally helpful. I mean, and look at commodities over time, just long only, like that's drives some of the
I think assets are something that you can kind of say when they're in a long drawdown that are probably more attractive. I'm just saying, like, in general strategies, I'm not sure momentum is.
I think that
better expectancy when it's in a drawdown or trend or what have you, right? But value probably does.
Presumably value.
Hold on a second.
Right?
You get
assets.
There's a couple things. One is, I think the algorithm is, you're in a period of drawdown or low returns. Is strategy broken? Yes or no? Yes. Abandoned strategy. Is strategy not broken? Well, then reallocate. But beyond that,
agreed.
if you have a long-term return of X, whatever X is on a fund, and that you're well below that return over some rolling period over the last 5 years or 10 years, at the end of the day, to get to the average, you must spend time at both above and below the average. So if strategy still works, you have some sort of expectation.
You're making assumptions about what the average is. I guess here's my example, right? Again, 160 different strategies, systematic strategies from the Q Factor website. If you allocate based on momentum or very long-term performance, risk-adjusted alpha, variety of different metrics, it being very strong, that's a bad strategy. It being very weak, that's a bad strategy. Holding all of them and rebalancing, that's an effective strategy.
So this is what we should differentiate, right? What you don't want to do is say value's down, I'm going to abandon ship and rotate everything into growth. And then when growth is down, abandon that ship and rotate everything into momentum, right? Like this idea of overconfidence, of hubris, is what we're trying to mitigate against. And I think
you have a strategic allocation, and the fact that something's down means you need to rebalance and add capital to it.
Again, if you believe in the factor,
you're out of balance with your strategic allocation.
Yeah. Exactly. So if you believe, but so there's certainly, I think, mean reversion in pure asset classes, and there's certainly an expectation of positive returns if you believe in that. And that's whatever strategy underlying. And then we've spoken endlessly about this very important factor, which is the premium that you can accomplish from pure entropy, right? From just noise, the ability to the rebalancing premium of adding to the losers and taking away from the winners and harvesting that volatility is an area of return that when you're simply switching from one to the other, this idea of factor timing rather than factor equal weighting and rebalancing, factor timing is a problem because you're also fighting against this rebalancing premium. Antti, in your interview with Antti, he talked about the commodity premium, right? Of owning a basket of commodities and the fact that they don't actually have a positive yield independently, but because of their non-correlated nature, that the basket you're able to harvest and create a positive risk premium from that balancing premium. Right. So in order to make a decision so bold as to transition from one thing to the next, you have to be willing to give up whatever you think that rebalancing premium is. Right. So that's all that kind of is a rich tapestry of everything we're talking about. Right. There might be over rebalancing on the asset allocation side, regular rebalancing from a strategic perspective on the strategy side. And then there's obviously the, whatever discretionary layer you want to put on top.
I mean, I think there's, like Meb alluded to, the fact that there's some, especially in asset classes. Again, there's a rabbit hole here, right? But there are better rebalancing frequencies than others in certain asset classes with certain strategies. No question about that, right? So there's some thoughtfulness there. But I guess what I was just trying to caution against was giving everybody the view that you should just sort of willy-nilly emphasize strategies that are in a drawdown. And I'm not sure that any of us is espousing that view.
Well, the good thing is no one will do that anyway.
Yeah, well,
right.
We're nudging in a direction, and it probably is constructive because
there's the right, there's the left. We're taking a position to try and nudge people a little closer.
Audience just dropped by 80%. Wow.
Yeah, that's right.
I
will give Meb credit though, because Meb, you do step into the swamp a lot in public, right? In terms of like just continuing to try and hammer home these very basic concepts where you're fighting the prevailing zeitgeist, right? Like several times a year for the last 10 or 12 years, you've been out in public saying, who owns trend funds, right? Or what is your allocation to trend funds? 0 to 5%, 5 to 10, 10 to 20, and like 80. For most years, it was 80% of 0 to 5, right? And this year now we're, maybe there's 30% are in the 5 to 10 range. And so we're moving. And you do the same thing with value, and you do the same thing with a lot of these, long-term strategic categories that everybody should have a material exposure to. And most people just don't, right? And it's amazing to see how much, like you say, vitriol that you
well,
get.
It's funny on the trend one is sort of like an apathy. I feel like it's like people just don't really care that much. They're just like, trend, like whatever. They'll care again, like they did in 2009 or 2003. Probably will start caring this year at some point. There's ones where people get downright like nasty and angry. Obviously, that's anything value related. If you particularly slap on the CAPE label, it's something really bad this year for some unknown reason on the home country bias, which is really odd to me because they only specifically apply it to the US. But I'm like, do you think buying all your money in Greek stocks is a good idea? And everyone's like, no, that's stupid. Okay, well, like it's but people go crazy on that one. And so I had a fun project for our team the other day, and I said, I'm not exactly how to find all these, but I wanted to demonstrate in a thoughtful way. And it's sort of like they do this on one of the late night comedy shows. But I said, I wanted to find all the really hateful, nasty, troll, public and private comments that people have made to me over the past decade. And I said, I know I could find some of them. Like you just Google Meb Faber, fraud, scam, whatever, like the 10 keywords. And we started to find some. And I think, having done this for long enough, and you guys too being in the public arena, I have a pretty thick skin and it's pretty funny. I was on TV the other day and someone had said, have fun losing money in your hairline. And so I said, I wanted to put these on shirts, and there's some really like creative, great ones over the years. And I was like, but I can't seem to find some of these. And I was like, I know where they all are. They're in the Bogleheads forum. That's where I can find
Of course, you're
a
totally
bunch of
right.
like, buy and hold investors. How are these the nastiest people? I'm like, Twitter is like, PG compared to some of these Bogleheads. And so we were trying to write an article about just surviving, not just about investing it, but as a entrepreneur too. But there's some really
No,
fun
that
ones.
Boglehead, we get them. Our head of marketing sends us some once in a while.
Yeah.
And my first instinct is to get in there guns a-blazing and start
Yeah.
throwing some truth at them. And then Mike's like, they're Bogleheads. Like there's nothing you can do.
And Peruvian Man 26 is not going to like hide you. That's not a good, avatar. But
That's right.
But for some reason the home country bias elicits a lot of like crazy ones too. And I don't know why that one in particular is such a hot topic.
Don't you think it's just the recency bias? I mean, really, the tribe becomes more and more tribalistic as they're proven right over longer and longer time frames. I mean, they've been right for so long. And I think that the home country bias in the U.S. is a particularly relevant issue there.
What are you talking about home country bias, Mike? If you invest in the S&P 500,
S&P,
you get exposure
you have
to
all
the
the
world.
international exposure, right? Yeah.
Right. It's exactly the same.
70% of the world's GDP is not in the US.
And I like to say your sample size is 1 out of 45. That is not statistical proof. That's the opposite. Like you just proved my point that investing all your money in these other 44 countries was a terrible idea. And then even the US, like you look back in history, someone's like, something about home country bias not working. I said, let's be clear. It has worked. It just hasn't worked in the past, 7 years. It's worked plenty of times in history where US has been far worse.
Roughly around every 5 to 7 years. It works for 5 to 7 years.
I was like, you want to go talk to all the Russians who just, had 95% of their stock exposure in Russia, and you think it's a great idea to put it all there? No, of course not.
It's crazy, that home country bias. Peruvians as well, a tiny, tiny stock market. They have over 90% of their assets in Peruvian stocks because I guess it's what they know, what they're pitched, right?
It's what they drive on the way to and from home every day. Yeah. Their friends are working at those companies. Like how can you not? I mean, it is a really tough thing to fight.
There's a huge false insecurity, and I love talking to people about this. They're like, "No, Meb, I understand U.S. stocks." I say, "Okay, tell me your top 3: John Deere, IBM, Google, whatever it is." I say, "Okay, and this is old Julian Robertson Tiger sort of concept." He's like, "All right, who's the CFO?" And they're like, "What? I don't know CFO." I'm like, "Oh, but you really know these stocks that well? Like, what was their, cash flow last quarter? Like, what was their shares outstanding?" And like on and on. It's like, it's a very weird false sense of, and you're seeing this with all of the high flyers over the past year. It's like half of NASDAQ stocks are down 50% right now. And all these people are like, well, no, but like, I understand telemedicine is the future, Teladoc or Shopify or on and on, like all these stocks. It's like false sense of relation to the product, the business. So you're familiar with the business, but you're not familiar with the stock. And those two things are absolutely not the same thing, as we've learned many times throughout history.
You're reminding me of an experience with Mike on a panel in New York City for the Ritholtz group.
No, can we just leave it nameless?
No, come on, man. I just love it. We're
never getting anybody back again. Never happened.
Yeah, it was about like investor education or something, and investors need to understand what they own. And Mike just going off on the moderator about how nobody understands anything that they own.
Nobody understands Coca-Cola.
Coca-Cola, what's in a can of Coke, and then like basically all the way back from what's in the can of Coke to the like Coke's business model and distribution and value the brand, and nobody knows anything, can't be told.
Before you use a toilet, you have to understand how the toilet works. Do you know how a toilet works? Yeah, maybe, certainly the audience seemed to love it. I don't know about the organizers.
By the way, Rod, Peru's having a pretty good stock market. I just looked it up. They're actually having a decent return this year. Commodity-based, of course.
Commodity-based. Listen, when
it's gone nowhere for 10 years, but
I know. So 08 happens, do pretty well, up because of all the stuff that we do. I have some Peruvian clients that were down 75+%. 09 happens. I think I do like 9%. Peru does 169% because the commodity bull market cycle had not finished, right? Could you imagine the vitriol that I got from those Peruvian clients? How could you have possibly underperformed so much? And it happened that in 2009, the best performing global market was the Peruvian stock market, right? So I've told my brothers and everybody that were like, the new president comes in, you know, we've had like 7 presidents in the last 18 months and nothing happens because the constitution that Fujimori created at the hands of the United States is actually held up. Like it's actually strong enough so that people want to continue to do business. I've said to them, it doesn't matter what your president are. Do not get your money out of Peru. You are going to make a killing this decade. You're just going to make a killing, and it's worked out pretty nicely. I you know, the buy and hold thing. I think Paul Nielsen comment. The funniest thing is that home country bias boglehead is a buy and hold everything, but only U.S. Right? This idea that buy and hold is buying the S&P 500 or the Vanguard 2,500 stocks. It seems like a passive, long,
that triggers me all the time.
investment, but it's a massive bet, right? This is a massive single bet. It's just outrageous.
It's not just home country bias, though. It's also, you know, equity bias too, right? It's I want to be passive, which means I'm going to own the S&P 500, which means I'm not going to own all of the myriad other global asset classes that are available to me. And if you believe in passive, you believe in efficient markets, and the average investor, just averaging every investor's view, is going to have the optimal portfolio. But you're going to concentrate all your money in the S&P 500. That's not a passive bet. It's a highly concentrated bet. But no matter how often you repeat that, that just doesn't seem to sink in.
All right, I got a question for you, man.
Mm-hmm.
Talked about how everybody was into trend in 2009. What does the average advisor portfolio look like in 2032, in your opinion? Right now, what I'm seeing is like 80-20,
look,
and
man,
the 20 is corporate bonds.
I don't know different than what we have today, probably.
Really?
You know, I think I love my advisors, but often, you know, if you go to these institutional conferences, you see the flavor du jour every couple of years. Doesn't matter if it's MLPs, doesn't matter if it's reverse Canadian Chinese companies. Doesn't matter if it's energy. Now probably you'll see the liquid alts and the trend start to get some curiosity. Those are kind of rinse repeat, and that's in sort of like the 20% over here bucket that like people get attracted to and barf up after they do poorly for a few years. The ballast of like a home biased portfolio, I think it won't be. I cannot fathom it would be any different. The trend following part to me is always funny because if you remove someone's bias in any of the trend following indexes over time and blind what actually has like the biggest benefit to a traditional portfolio, it's almost universally always trend in some form, right? You can add some of the, I mean, depends on what the starting point is. Like if you have no real assets, which is a trend, by the way, that almost no investors, you guys Canadians different, almost no American investors have real asset exposure. You know, on our Twitter polls, like we ask, and no one does, you know. That's clearly a mistake, particularly look at the last year. So there's things, it's like this old, you know, will it go into the optimizer? Will it help? You know, trend clearly does. You just have to deal with like the suck, same as any asset, right? Like that's the thing. So anyway, I don't think it's any different. You know, I can't imagine.
When you say trend,
tell me what happened from 2030 to 2032, and then I'll tell you what they own. But I don't know if it'll be any different.
When you say trend, Meb, like I think a lot of people still sort of think of trend as being like, I'm a trend follower by following a 200 moving average strategy on the S&P, right? But that's not really what you're referring to, right?
You know, like I think I would say when most people think about it, I would actually assume they think managed futures. I could be wrong. You know, they're like, it's like saying value. There's like obviously a emerging markets value fund is different from a DFA USA fund, is different from a valuation ensemble, which is different from a dividend fund, right? Like even the dividend funds are different. They're cousins. And to me, it's the decision of like, are you making this broad decision in the first place. Okay, then what markets? Okay, and then is it long, short, etc. I think in many cases of the just broad trend, like you want the beta of trend following. And I think, and we've said this a lot, to a traditional portfolio that's long only, a long short style managed futures to me is probably the best complement, because it's probably the least correlated. On an absolute basis for a long period, if you're going to do trend on like the whole portfolio, for me it's long flat, because shorting, I mean, look, shorting is great, but it's tough. Even the managed futures, most of the profit over time tends to be from the long side, but it just depends what you're starting with. If you're starting from scratch, I'll take long flat. That's my desert island portfolio. To me, a trend long flat is better. But if you start with a traditional portfolio, which is almost what everyone does, long short is a better complement to that.
Because in essence, the short will end up starting to flatten out.
It diversifies the other stuff, right? Like it's a very specific worldview of a traditional portfolio 60-40. Like you guys obviously start to gravitate towards a more thoughtful approach to that, including real assets, including some vol targeting ideas. But then to me, the 60-40 hedge, because like let's look at this year. Like so many investors assume bonds are going to help, no matter what. And then you have this environment where you have rising inflation. So what really helps there? Well, commodities help, real assets, REITs, tips. But being short those assets also helps, on the managed futures side. So the problem with managed futures, often, to me is like, again, I want the beta of it. Like, I don't even really care about a specific manager so much. I would just like to own some general. Signal.
Well, as you say, I mean, we've experienced pretty significant profits from shorting bonds as an example of a way to fight inflation. Yeah. And that's a misunderstood concept. And I think it's tough, right? So how do you continue to have a position in your portfolio that shorts bonds when you started with a rate of 20%, call it in 1982, and it went to zero? That's a pretty sharp stick in your eye for 47 years.
We a good example, like the Japanese trades, the yen seems to be cratering currently. So if you guys want to go skiing in Japan next year, talk to me, because it's like 20% off.
That's a great idea. That's the next the FinTwit conference.
When do we have to book that? When do we have to make a commitment to you to do that?
Summertime probably.
Okay.
Fall time even. Awesome trip, but we should do that. Going back to Auntie's book, you guys, when you chatted with him, kind of was my prep material. And so, but I looked in the book, I got the one chart and I was like, oh man, this chart is beautiful, because it shows a good example of a widely held belief, which is bonds are always going to help stocks in a downturn, is not guaranteed, right? And you look at plenty of times in history, a lot of asset classes, like they help on average, but sometimes like you cannot count on it to help. And so, as you mentioned, like being able to short bonds, and I think managed futures are probably universally having a monster year this year. I don't know that, but I assume.
Yep.
Being able to shorten that environment is a big keeping you in the game sort of idea.
Yeah, I mean, I think if you were to look across managed futures, like if just looking at our managed futures, we have the same P&L from our short bond trades as we do from our long energy trades, right? Like that's how important the short bond component has been for trend followers and managed futures funds this year. And I think that is largely unrecognized. Everyone's like, I want to get access to commodities, but being able to short things that are like functionally and mechanically going to do badly in an inflationary environment is
the funny thing is too, Adam, though, how some long-term, lived trend followers are talking about how that doesn't make money ever. And that
what doesn't make money ever?
Shorting bonds, because whatever roll yield, etc. I think Niederhofer is famous for saying.
Well, no. The reality is, if you go back through, we've published on this, right? If you go back to 1990 and you and you examine the attribution of P&L for bonds, all of the P&L, like 125% of the P&L comes from the long side, because the short side of a trend following bond strategy is negatively accretive. It has negative returns, right?
Moreover, I mean, the bear markets that have existed historically have not been, the CTAs have not made most of their money from shorting equities. They've made most of their money from going long treasuries, right? So in an environment, in an environment of benign inflation and bear markets, you're going to see treasuries be the safe haven.
Yep.
Try to do that in the 70s. Try to go long bonds to protect against bear markets in the 1970s. You're done.
Yeah.
Try to do it today.
Which is why it's so important to be asset class agnostic. It's easy to say, I think hard for a lot of people to do, and you guys do it probably more than anybody, but so many people, you know, they just they adhere to one environment, and that environment changes. Like, you're up Schitt's Creek, man. Like what do you like? That's a terrible place to be. And I said, I've been saying this for years. I said, you know, people say, like, what keeps you up at night? I said, nothing. I sleep fine. However, if I was an allocator, and a lot of traditional allocators, the nightmare scenario for them is a big fat US stock market dump and bonds dump too. And 2022, this is happening now. Whether it gets worse or whether it gets better, who knows? But that is a nightmare scenario for them, because what they've done over the past 5 years, and they said, well, we know we can't get returns from stocks and bonds, so you know what? We're going to buy private equity. Well, guess what? That's just like 1.5 times leveraged stocks. So you just made the problem worse. And, you know, this has been their savior, and it's going to be.
But we're not marking to market there, though. I mean, I think we're in the beginning stages of a much longer sort of potentiality, which is going to force them to market. But thus far, the marking to market is the thing that saves them. That they can't look at it and they don't report it. It doesn't affect the funding rates. I mean, don't you think? Like isn't that why they're doing it?
But every 3 years is kind of like when people stick around for as the board member of that underlying strategy, right? So if you can stick around long enough where you can't mark to market and be blamed on you, then you're in good shape. This is why it's useful, right? The reality is, though, is valuations high means returns low. It doesn't matter that your volatility is doled out over 3 years. You should expect a lower rate of return from private equity. And if you're levered 1.5, then you should expect an even lower on the downside. So that should be the fiduciary responsibility of identifying what it's likely to be like in the next 3 years, not these cover your ass and keep your job thing that we tend to see, right? It's unfortunate, but you're right. That is the nightmare scenario. The underfunded pension plans that exist out there that are 100%, like that are 90% bonds, 10% equity too.
The pension funds have a bit of a ballast, right? Because their discount rates are also rising. So the value of their liabilities is also shrinking while their assets are shrinking. So there's a bit of an offset there. Whereas, for example, endowments, which have really embraced the private equity and private credit. I mean, look, endowments have been bailed out because even while EBITDA yields on private equity vintages have continued to decline over the last decade, the cost of capital has declined at the same rate because rates continue to go down and spreads continue to compress. But I think we're coming into an environment where the EBITDA yields on new deals are crappy and the cost of capital is much, much higher. And so the expected return on new vintages is going to be, I think a lot of endowments and institutions who've been gravitating towards private equity are in for a bit of a rude awakening over the next 5 to 7 years. But, everyone's got to learn the hard way.
Yeah, I think it went from 5x EBITDA to 12% EBITDA in the last 5 years, 12 times EBITDA.
Yeah.
So what?
But Meb, don't we have? Aren't hedge funds expected to return between 20 and 15 and 20% over the recent horizon from all pension plans and
it's like
so they're going to
Charlie Munger quote. There's a great Charlie Munger quote on that, where basically he's like talking to somebody and they're like 20%. He's like, he knows that's impossible, but he has to claim 20% plus expected returns because no one will buy the fund otherwise, right? Like, it's this classic game of just like, you're not going to do that, but you have to say it, otherwise no one will invest. And so I do a lot of angel investing, and I see some of the claims these guys make, and I'm just like, man, you better hope the SEC never digs into these, because what you were claiming is just full cringe, right? Like this is not something you should be saying on paper. So
Mike and I witnessed an uncharacteristic moment of truth from a very large Canadian institutional investor. Remember this, Mike, 5 or 6 years ago, maybe a little longer? We went to this presentation from the CIO of the largest municipal pension plan in Canada. And she described their RFP process. And she said, first of all, they sourced their providers, their advisors from the board, who suggested like 9 different potential advisors. Red flags everywhere, right? But anyway, so they went out to these 9 different advisors with, they said they needed 5% above inflation in perpetuity. And 8 of the 9 advisors came back and said, we cannot propose a portfolio that meets your constraints that will achieve that 5% above inflation, right? One of them came back and said, yep, here's the portfolio we propose that we think will meet that requirement. Who do you think the plan went with?
There's a lesson in there, you guys. This is why none of us are managing 50 billion. So
oh my God,
this is we need to.
We got to get out of our own way.
Just astonishing.
It's too good.
Well, Meb, what else are you working on these days? You still doing the chart book?
I was gonna say, Meb, what's the thing you're gonna write about next? Like Vamo was. Like, what's on the radar now as being absolute dog poo that you're like, well, this has got to be attractive.
Okay, well, you just asked like 3 separate questions, but I'll answer the last one
you like best.
I'll answer the last one carefully, because obviously we're a fund manager, but I'm not going to speak to any specific fund.
Sure.
This is just conceptually. If you're looking at emerging markets, and particularly value in emerging markets, Russia was obviously a giant crater for many of these funds. Now, the interesting part of this is all those funds have now written down those stocks to zero. So if you buy an ETF in an emerging market fund, and 95% of emerging market funds held Russian stocks, those for ETF, or usually I assume for the mutual funds too, they're valuing those at zero. Well, as we know anything about probabilities, if you had to game plan the Russian stock market outcome, there's, I don't know, let's call it 2/3 probability that this resolves over the next year. Russian stocks start trading in some capacity. Maybe it's 50% chance. I'm not sure. And they're worth, I don't know, 20 cents on the dollar, 50 cents on the dollar, maybe. I'm not sure. There's a minority chance, 10, 20%, that the situation gets worse and those stocks are forever zeros. They're just gone. Just like they were in 1918 during the Bolshevik Revolution. Russian stocks went to zero. There's also a chance, 10, prediction markets have it at 20. I think that's too high, but that there's regime change, in which case those stocks are not only worth par, they're probably worth more than par, because they were trading at extremely low valuations prior to this. Already. So it could be a par, and a par, from where they're marked at zero, but even if they were marked at 10 cents, it would be a 10 bagger on those stocks, maybe 20. My point being, and you have to be agnostic as to political yada yada, you're getting a free call option in any emerging market fund that owns those stocks. Now, some may have only owned 1% of their NAV prior to this whole shebang. Some may have held 10%. Now, I'm not talking about the ones that are all in, because I have no idea how those actually would trade, because they got halted. But the ones that are freely trading, it's an interesting opportunity to pick up something that has an embedded free call option that I think is interesting. And emerging market value already is cheap. A lot of Eastern Europe, a lot of the rest of the world, Latin America, some of Asia is sprinkled in there too. I think that's an interesting opportunity for the next 5-10 years. No idea what's going to happen the next year. And interesting, if you told most listeners that the ruble is actually higher than where it was before the invasion, they would say, huh, really? That's interesting. But there's the old Rockefeller quote. And again, this is insensitive quote, but we're speaking specifically just to markets and history. The quote was sell on the sound of cannons, buy on the sound of, no, backwards. Sorry. Buy on the sound of cannons, sell on the sound of trumpets. But to me, look, I'm an optimist, pacifist. I want this to resolve. Hopefully it will in a meaningful scenario. Probably won't. But there is a scenario that, the Russian people, the Russian companies, which are not the administration, ditto for every shit government in the world, right? So there's an opportunity there for emerging markets, I think, that's interesting for long-term investors. But that wasn't the second question. That was just the last question. The second question is, what am I writing and thinking about? There's 2 books I really want to put together, and I hate writing books, so it's complicated. Now that we're to sell in May and go away for the summer, I'm looking forward to a sabbatical for the next 5 months of just not watching markets. There's one book where I'm really motivated to try to see if we could frame getting everyone to be an investor, particularly the younger cohort, but in the right way, not the Robin Hood way, which I think is a company that history will not judge kindly, by the way, but to try to educate people to all be investors, right? And so I've been trying to think of a good way to connect with people to drive home this message. And one of the best ways I've been thinking of is saying, hey, look at all these famous celebrities, athletes, and we also include regular Joes. So George Clooney, Shaq, the Williams sisters, Ashton Kutcher, on and on and on. They made decent money at their day job, but they made the big money, Dre, 50 Cent, big money from business, right? Whether it's tequila, headphones, clothing, on and on. And so this is kind of this instructive book, I think, that is thoughtful. That's done. And the tentative title is called Be the Owner, where you just you don't have to go start an entrepreneurship venture. It could be like, hey, Michael Jordan got this amazing Nike endorsement deal. Well, you're probably not going to get an endorsement deal, but what if you bought Nike stock? At that time, how would it have been? On and on. Anyway, that's maybe a summer project. And there's a kind of picture book version of that I want to do. But again, these I would have liked to have done the last 2 summers and got a pandemic and whatever we have coming down the pike.
Now, if somebody buys the book, will you be able to buy Lambo in 6 months, or is that not in the cards?
My friends who have Lambos all say it's like the most uncomfortable car. And they're like, in no way do I enjoy driving this car. My favorite example, and I like cars. I'm kind of a car guy. Shitty cars, like old SUVs. My favorite was my first car was a 1980s Land Cruiser. I had a 1960s before child, but I love Morgan Housel in his book, which is he could buy one because he's sold 1 million copies. I give all mine away, so that's my problem. Is we've given away. I don't know if it's 1 million yet, but it's certainly hundreds of thousands. He had a great analogy about cars where he said, the thing about being a millionaire and about people who want to, get rich is he's like used to be a valet, and he's like, everyone sees the Lambo pull up, and you go down in LA, you see these cars everywhere. Crazy. I was getting coffee, and I saw the ugliest car I've ever seen. It was like a Rolls Royce SUV. And I was like, that is the ugliest thing. Anyway,
I've seen those.
But sorry if you guys have one in the Cayman. People say they look at the car, pull up to the valet, and they're like, wow, amazing. Look at that Lambo. And then person gets out and walks away. But his analogy, and this is Morgan, I'm paraphrasing. He's like, no one, they look at the person and get out and like, is that Drake? No. Okay. They never look at the person and say, I want to be that person. They say, I want to be that person in the car. Right. But then the person in the car is thinking everyone out there is looking at me and wants to be me. And it's not a connect, it's a disconnect. Right. And so it's just, when you think about money and having money, it's like everyone wants to spend $1 million because they think it's going to give them this sort of aura, when in reality, people are not
care
looking
about
at
the
it
money, not the person.
Right.
Yeah.
Right. So anyway, I like the experience. So I'll go with you guys to Vegas if you want to go drive the cars around the track for like $500. But the one you really want to do there is not the supercars. It's the Baja truck where you launch off these giant jumps, and it is so much fun.
What's a Baja truck?
It's
What?
that
Yeah,
Baja
prove it, man.
race.
I don't know.
It's
I
the
go on a
dune
motorcycle
buggy.
and a bike. Like what?
It's like the dune buggy,
They're like the
truck.
super steroided up dune buggies, like the Razor, the Raptors,
Oh, like-
Razors, like
Okay.
Bombardier makes
Yeah.
a bunch of, like, I mean, super
with the
steroided.
it has
up,
a
though.
frame though. It's kind of
Correct,
like a tiny
yeah.
frame.
A roll
The
cage.
A cage. So
Yeah,
when
you
you
guys-
roll, you don't
At
die.
my
It is.
size, there
It
are
is.
no sports cars for me. So I'm with you, Meb. Big
You
old, like,
can't fit 'em in anyway. You got to be like Shaq. When Shaq had his
totally.
car, he sat in the back seat. I
Yeah,
forget which one. They just removed the front seat altogether, so he just sat where the back seat would have been.
I love the old the 1972 Ford Bronco 2-door. Take the roof off. That thing is a masterpiece.
I had a reservation for the new Bronco and actually really liked it. Just not practical in LA. Like that thing drive. If you guys have driven one, it's pretty fun, but it's like it's a truck. Like it.
Yeah.
You want that in Toronto or Calgary. You don't want
Looking
it
it up.
in
Ford.
LA. Yeah.
The new Bronco's nice.
Bronco.
I saw them. You have to get the really nice one. They kind of, and the lesser versions are not quite as trucky.
No, the lesser
for my
version is like a
liking,
Rav
anyway.
4, not a Rav 4.
Yeah,
What's
exactly.
the
Yeah, sort
Ford
of like that. The CRV. It's like a
CRV?
yeah, like the sort of
That's a
It's
Philbrick
terrible.
truck if I've ever seen one.
yeah.
That is right up your alley.
A good Ford truck too. Drives like a truck. Drives like a. Anyway,
I
down with the
reserve
Baja
my
stuff. It's
Cybertruck.
Amazing. I love that.
That would be
I
cool to
reserve my
change from the
Cybertruck.
Leaf, mate.
Yeah, right.
That's right. From that one of those. No, this
From a guy who
Cybertruck
drives
was
a Nissan
amazing.
Leaf. Here's what I drive.
I actually I'm shocked because everybody's like, "Oh my god, you're gonna buy a Cybertruck? That's super expensive. They're 40 grand. You can get a Cybertruck at 40."
You see
I'm
the
in.
light, the Ford ones now, they like power your house. Like you can like
Well,
power
that's the
your house
same
for
thing
like
for
3 days.
Tesla. I bought so I reserved a Ford F-150 Lightning
Yeah.
because it's also like 40 grand. But then I saw the
Bot's
Cybertruck
gonna
went down
have
that
3
rabbit hole.
trucks in 2 years.
And I'm like, this Cybertruck crushes the Ford F-150 in every respect, like in every element. Like you just go down the list. It's not nowhere close. So as
Yeah,
soon
but
as
I
get my
kind of
Ford,
feel like Elon
I'll probably
and
get the
Kathy
Ford
Wood
first.
have the same tendency to elaborate on their like their Tesla's stuff does
you-
not quite match.
you shut-
its claim.
You shut your blasphemous
Okay,
mouth.
okay.
Okay. Just take it,
Okay.
take it back, my friend. All right, and then, and you know what? I'll give you the Ford F-150 for free, and then we can
thank
do a
you.
little.
You know what- you know
There's
what
a
I should've
drag
done?
racing, Meb. There's a drag racing that just opened up on Island, and I want you to be here when Mike and I go head to head on our.
Well, it's
respective
LA,
trucks.
so there's a drag queen bingo here, and you guys come visit me. We'll take you to that. Slightly different than the drag racing, but drag queen
Drag.
racing we might have.
yes.
But I
Mike
tell you,
will
you
be
know,
there for sure.
one of my least favorite things people like the phrasing they love to use on stocks is like in Tesla. I own a Tesla, but hey, I made so much money on Tesla stock, like it paid for the car, like that phrasing. And I actually wanted to be like, as a Tesla owner, it'd be like, I shorted the stock. I made so much money on a short that it pays for this. Like, never hears anyone say the other, or never hear anyone say, you know what, I lost so much money on this stock, I have to sell my car, right? Like they never say that. So anyway,
On that note,
I love it.
yeah.
Meb, you've been very kind with your time as always. Very entertaining stories. Where can we find you? I think people already know, but
You can. I'm homeless, so you can find me looking like the dude just wandering around Los Angeles. And if you see me, wave at me. It might be a homeless person.
Buy you
It
a
might be
burger
me.
and a coffee and
Yeah.
pack of smokes.
Yeah, man. There's not too many Mebs out there. Although I was laughing this morning. I was going to
Or
tweet
like your
this,
dad.
and I was going to tweet this where I said, you can only use so much market history. Like as a stats person, there's only so much in the past. Like we joke about how much 120 years, but in reality, it's actually not that much. And I said, based on my history, I'm a coffee drinker. I drink coffee every day. It's a beloved addiction of mine. But I say every time I go get coffee, my name is Meb, M-E-B. I even spell it. I've had probably 100 variants, and usually it's Ben or it's Mel, when they call it out. And I said, today, despite my history of 20 years of coffee drinking, and I got an entirely new one, and it was Mev, M-E-V-E. You can see it on my coffee here. I was so happy about it. So I get excited when they come up with a new one. There's little pleasures in life. I don't even remember what we were talking about.
The
where
question
can you
is
find me? What's that?
Where we can find you?
You can find me hopefully in the Caymans in the coming months. Sabbatical and finishing these books. Driving around, drag racing. In the meantime, I'll be in Los Angeles, Manhattan Beach. My day job is running Cambria funds. My side job is the Idea Farm. You can watch me.
Where can people sign up for that? Do you get the free?
Yeah,
theideafarm.com. Yeah, simple.
And it's free now. When is it actually free? Is it free now or Sunday, or when does it actually go
free
on?
as of today? Yeah.
Dude.
I just saved. This is a $1,500 free call. Saved $500 each, and then I said, amortize it for the next 10 years. So really, this is like a $20,000 gift, you guys.
Thank you. By the way,
Talk about hubris.
Yeah, exactly.
Revenue source.
Yeah. So any of those places, shoot me an email, Twitter, all those places are good to go.
And you're one of the few guys that actually picks up the phone for random dudes who want to. Yeah. Okay.
Do not call me.
We'll edit that out.
Do not call me on a FaceTime.
555-5555.
I used to have our work office number is very close to what you just said, by the way. It's like off by like one number. So
why am I not surprised?
Amazing.
Yeah.
Of course you do.
It's actually 867-5309. Listeners, call me, LA area code 867-5309.
Is that your brother-in-law or something?
Nah,
no one under 40 gets that. So
no, I know. Rod doesn't know it either.
Okay.
You guys can play it for him after
All
the
right.
I'll
call.
sing a
should have it
bar on
as
the
the
way
outro.
out. Exactly.
Awesome.
Awesome.
Well, thanks,
Yes.
Meb. Really appreciate your time as per usual.
It was
Get
fun.
to Cayman Islands.
Come
And
see me here too.
let's figure out
Yeah.
Japan.
Let's figure out Japan. I'm in.
I've got to figure it out. You guys just got to go and pay for me, and that's it. We'll call it a
Well,
while.
it's easy. We got a guy.
I'll be your tour guide.
Yeah,
Konnichiwa.
done. When is
Arigato gozaimasu.
So
Arigato
when are the
gozaimasu.
dates? Just send us the dates.
Yeah.
I don't even know if that's. Can you do that now? I don't know.
Come back, speak Japanese? You can. Yes. That was legitimate Japanese. I did 6 months. Okay. And I remember 3 words.
Legitimate
6 months of
Japanese, verified by Rodrigo.
Exactly. I don't even know.
Exactly right.
You
It just
heard
got
here
better
first.
there. It just got better.
Yeah.
All
right.
All
Thanks,
the best.
man.
Thanks
All the
all.
best,
Thank
Meb.
you.
You
All
and
right,
your
y'all.
fam.
Have a great weekend.
You too,
You
brother.
too.
Good luck with
See
your
y'all,
renos.
guys. Cue the music.
Most investors feel comfortable with their domestic equity and bond portfolios because they tend to thrive during periods of economic growth and low inflation. And we don't blame you. It's been a great ride. But it's a big world out there, full of opportunities you may be ignoring. Sadly, we live in a world dominated by a fear of missing out, or FOMO. And in the last 10 years, U.S. equities and bonds have outperformed and generated massive amounts of FOMO. This hasn't always been the case. In the mid-2000s, the best performing markets were international equities, especially emerging markets, gold and commodities. So what happens if growth collapses and inflation becomes the new norm? Or what if the US dollar collapses and US assets are no longer attractive? What will the new FOMO markets be? And will your portfolio keep up or be left behind? Enter Rational Resolve Adaptive Asset Allocation Fund, ticker RDMIX, a strategy that is designed to thrive across different markets and economic regimes. Unlike most traditional strategies that keep allocation static and let volatility happen, Adaptive Asset Allocation applies a proprietary systematic process designed to dynamically transition toward thriving asset classes and eliminate those that are not, all the while aiming for consistent volatility and stable returns. There's almost always a bull market somewhere in the world. Don't let yesterday's FOMO get in the way of tomorrow's opportunities. Instead, let Adaptive Asset Allocation help you fill in your domestic portfolio gaps. To learn more, visit rationalmf.com and check out the Rational Resolve Adaptive Asset Allocation Fund.